After all the market volatility of 2022, it brought to mind the tempest and of course the famous quote, "What's past is prologue." What can we learn from our past that can help us get ready for what lies ahead? So what's past is prologue. Won't take you all the way back through the Tempest in your high school English class, but Antonio, who's plotting a murder, is basically saying, hey, we're victims of our fate. What's come before has set us up for this moment. Not a big fan of the sentiment. Certainly the things that have led up create a context, but we're still in power of the decisions that we're going to make, particularly as investors. They reflect themselves in our plans, in our portfolios. So as we look to 2023, wanted to go back to 5 important truths, particularly true during market struggles, to keep in mind. And then again, look at the context of today's market to try to create some applications. The first truth is buying low is scary. So a lot of cash on the sidelines, record levels of cash on the sidelines, getting lots of calls from people who say, what do I do with all this cash? And there's lots of things, it doesn't have to be stocks, but the point is, to the extent that you think equities or other things might be a part of your future, keep in mind, this is kind of what buying opportunities look like. I'll get the conversation where people say, yeah, but it looks bad and the data's bad and this is bad. And it's like, that's what a bottom looks like. Things look bad. When everything looks rosy, when everything looks super positive, and the last time you saw sentiment above 90 was right before a little thing called COVID happened. So again, as we'll touch in a little bit, fade the herd, fade your sentiment is usually the right path forward. And again, do what seems so contrary to your nature. The second one is recency bias skews perspective. This is true in all sorts of things. Personally, if we're going through a tough time, or maybe we're going through a particularly good time, it's so easy to think that that's just going to continue on indefinitely. If you look at sports, every year, whoever wins the Super Bowl is the favorite to repeat the next year. This year, the Rams were supposed to win 11 games with over 93% of money. I looked this up today, being bet on them to win more than 11 games. They won 5. So again, it's easy to assume that what we just saw is what's going to continue to be. But what history shows us, whether it's the NFL or whether it's the S&P 500, is what's likely to happen is a surprise, especially once Tom Brady retires here soon. Point number 3 is fade the herd. B of A's strategist Sanvita put out a piece this week where he talked about one of the reasons he's optimistic, as we've touched on in prior commentaries like last week's, is just because of how bearish everybody else is. Bullish sentiment is only at a 20% reading. That's less than half of its historical average. And we just posted the 40th straight week where bears were higher than bulls. If you look at a composite indices, there's more on this in the written commentary. This is only the first time that composite indice has been a full standard deviation plus below its historic average for more than a year. The last time that kind of dour sentiment persisted for that long ended in June of 2009. If you look back, if you think back on that market, it all felt bad. The second shoe, commercial real estate, was going to drop. Turned out would have been a heck of a time to buy just about anything out in the world. Point number 4, and we're going to put these last 2 as we look at kind of the key power struggle that's going on right now between inflation and corporate earnings. Number 1 is keeping in mind that markets move far more on trends than they do absolutes. So if you could even create an objective absolute, and granted there's lots of readings, plus or minus 50 on this or that have some objectivity to them, but what the markets really care about is improvement. Less bad is better than something that goes from great to good. And I think that confuses a lot of people. They say, well, this is bad and this is good, so this must be better. Now, where were they coming from is really the key point. And the second one is, again, on that trend, expectations. As I just told you, expectations right now are incredibly low. And so those kinds of low hurdles are usually, again, the things that start to stack up when you're looking to be able to strike on opportunities. Last point, point number 5, markets look forward. A lot of chatter right now about the upcoming earnings seasons. By most accounts, it probably shouldn't be great. I think the key thing with whatever little day-to-day turmoil might come about is markets are usually looking 6 to 9 months out. And if you look 6 to 9 months out, what you'll find is while earnings growth estimates are coming down to about mid-year, then they start to move back up. And so again, Wouldn't surprise us to see markets move through this earnings season and again, begin to surprise people as they often do by getting some renewed strength. They're up 7% since June of last year, by the way, and 11% since the October lows. While things are still dark. That's usually how markets begin that turning process. Speaking of inflation, just some quick data points. Again, looking at trends and looking forward, the data continues to roll over hard. You had Bullard, Fed chair in St. Louis, come out this week and say, you know what, we might be getting to a rate level that's sufficient to quell inflation. That's significant for a number of reasons, but not the least of which is he was one of the biggest hawks, i.e. proponents of raising rates last year. Some evidence of this, the producer price index just plummeted from its post-COVID highs of 89 down to a reading of 39. You've also seen shipping costs go from $20,000 a container. Now they're down to pre-COVID levels of $1,300 a container. And so again, the evidence is there that inflation's pulling down, the Fed should be able to ease, that earnings should begin to be hitting their bottom in the near term. And again, in a time frame that's very indicative of how markets would begin to strengthen. A lot of what we're going through right now is why we finished last year in a bear market down 20% for the calendar year. So just like Antonio and Sebastian in The Tempest, yes, the past gets you to a point of context, but unlike their sentiment, what we do from here is so important, pun totally intended. When I say, what we need not do is kill our financial plans and our portfolios by, again, making an emotionally based decision, following the crowds, as opposed to, again, following all of those things that we've learned from looking back at the past. If you've got any questions on this, or again, an array of different options that are out there for you if you're looking to invest, reach out anytime. Thanks so much.